Ranveer sir?
Hello, can you hear me?
Good afternoon, sir. Sir, your volume is as such very low.
My volume is low.
Right, still, I mean,
Just a second.
sure.
Hello.
Yes, sir.
Now better?
Yes, sir. Better.
Yeah. I'm using my desktop, so I won't be able to share my video means. So
That's okay, sir. So, shall we start with the session?
yep, I can.
Okay. So once again, good afternoon to all participants. The essence of investment management is the management of risk, not the management of return. With this quote, I would like to once again welcome all the participants and our resource person, Mr. Pranvesh Chatterjee, who is going to teach us about the portfolio management using R. So once again, welcoming you all on the day 3, session 3 of online STTP sponsored by AICT, organized by IPS Academy Indore. So Mr. Chatterjee did his MBA from IIM and his bachelor's from BIT Mesra. With 6 years of teaching experience, he holds command in machine learning and analytics, financial management, corporate finance, business statistics, information technology, and marketing research. He's serving industry for more than 10 years through holding strategy position with firms like HCL, Accenture, JPMC, Ocwen, EduCBA, Cyber Tech System, and Softwares, Wipro, and MDOS. So once again, we are welcoming you, sir. Ranveer sir, over to you, sir.
Thank you. Thank you.
Thank you, sir.
So good afternoon, everyone. Hope you had a good lunch.
But we hope the same, sir.
We will start with the session. So as you would know, this session is all about financial analytics, and the main focus of this course will be on hands-on techniques to analyze various financial concepts using R, right? I will not be getting into the depth of the financial concepts as such. I think that would have been part of a, I assume most of you are well versed with the most of these financial concepts that we have been seeing. What we will be basically focusing on is how do we implement them in a platform or using a known tool. There are multiple platforms in the market which help you to do portfolio management, trading strategy, and all. There are a lot of graphical user interface based tools also which are being used across some of the large trading firms. They have many of them also have their in-house software. But uh, the most commonly used open source software in the market, which is uh, used for financial analytics, are R and Python. Python we will not be covering in this course. We will be focusing on R. Most of the things that you can do in R, you can also do in Python and vice versa. But yes, if we can master one of the concepts, one of the tools, the other tools also will not be that much of a problem. So with this context, let us start the today's session. So just to give you a brief overview, we will be covering various trading strategies, the indicators, how do we implement them, the charting methods. Um, then moving on, we will be moving on to portfolio creation, portfolio specifications, efficient frontiers. We will also cover the basics of CAPM model and SARP ratio implementation. And we will be using many of the time series concepts like simple moving average, REMA, in doing some of our analysis. So let's begin the session for today. I will be sharing my screen. Mm, Good. I hope most of you would have installed R and R Studio in your machines. Um, in case you don't, I would advise that get it installed. I think you had a course on R and R Studio. I mean, the basics of R being covered for you. I know it is a little 1 or 2 days of course may not give you that much of in-depth understanding of R, but it will give you an overview of the power, the functionality that R can give to the end users. And the more you practice on it, the more better you will get. Um, and in case you already know R, then nothing like it. If you would have been doing or some of the analysis using R, then you are already familiar with it. So, so the basics of financial analytics is the most basic concept or the most trivial um, component in a financial component in a financial analysis is a stock price. If we know how to analyze stock price data, um, we can very well carry it on to the other financial instruments, like you have the, whether it is a forex market, uh, whether it is any other financial instrument that you would want to analyze. The concepts remain absolutely the one and same, right? So let's um, the first thing that we will understand, I presume most of you will not be aware of the various libraries and packages that we will be using. So just to give you another background on R has already inbuilt functions and packages that we use in order to do our analysis. Say, for example, we want to analyze the returns on a stock. What we will be doing? We will basically use a library in time series and which is called as XTS. Maybe we can use time series. There are a lot of packages which are available in R. The way we install those packages are, we go to tools, we click on install packages, and we can type the name of the package that we want to install. Now, let's say we want to install a package called as quant mode, which is one of the most um, widely used financial analysis package in R. So I will install quant mode from here, and then I just install in quant mode. So if you see, the repository that is selected is something called as CRAN. Now that is the widest source of CRAN is the widest source of libraries that are being hosted for R as a platform. And all your functions, most of your functions and others are available in CRAN. So they do a lot of quality checks and everything before anything is installed in CRAN. There are other packages also which we cannot use CRAN for them, but we will see like how do we use them in uh, without using CRAN as the source of our library. But for starters, we should know that CRAN is the source of all the libraries that we need for getting us started on a financial analytics platform. So good. Now, hope all of you are clear. I already have installed Quant Mode, so I don't want to install once more. Um, but um, in case you have any problem, you can just ask me, or like when you start practicing, you might have questions on them. So right. So, but for the knowledge sake, we have these libraries that are very much used, right? The first thing that we want to really see upon is how we can get the data, right? Means, so in R, there are a lot of uh, uh, libraries where we can connect to various of the financial platforms like Yahoo, Google, and other platforms also, and we can get the direct data from them. Um, if it is S&P index, we have the package for S&P index separately. Even the Indian stock price index, there are packages which are available, which helps us to get the stock data from uh, directly from the NSE or the BSE websites, and we can directly port the data into our environment. So we will not be covering the entire data, but we will be using few of the sources of data that we have in order to analyze our in order to implement some of these concepts. So the most important, the first thing that we have to use is something called as library Quant Mode. Always remember this option of the package being available in your environment will only be there once you have installed the package using the tools option. If this package is not there in your environment, you will not see this. This program will give you an error. This line will give you an error. So once you have installed, you can directly invoke the library in your environment. So once you invoke the library in your environment, this library will help you to get the various data. Let's say, I want to get the data for a company like Apple. Okay, let's create an environment, a variable called as AAPL. And this is the common syntax that we use in order to assign something to a variable, right? I want to assign the stock prices of Apple to a variable called as Apple. And this is the assignment operator that I will be using in general. We can also use the equal to, but this is the most commonly used R symbol for using the assignment operator, right? The function that we use is something called as get symbols. Okay. So get symbols is a function in Quant Mode library, and it helps us to get the data from, let's say, Yahoo platform or Google platform. So let me use Yahoo as the platform from where we will get some of the data for Apple. So here, uh, each company will have a ticker assigned to it, which you can get it using, which you will have to use in order to get the data for that particular stock. In case of Apple, it is AAPL. And let's say I want to download the data from, there is a variable called as from, and this we use, let's say I want to get the data from all the way from 2019, 1st of January. So I will give from which date I want the data, and then I have to give one command called as auto.assign. This auto.assign is an environment variable, and it helps you to get the stock data in your environment, basically, right? So let's see what happens when we run it. So what we basically do is we select both the lines, and we just, here you can see button called as run. Okay, even before that, you might be aware there are three panels in our one. You can see is the console panel, which is towards the bottom left corner. The upper left corner, as you would know, is basically the scripting part where we write our program. The right bottom corner is helps you to get the plots or know your file location, know your package location that you have installed, and other things. The top right corner panel helps you in identifying what are the variables that you are going to get created, and they are locally getting set for you in your environment. So let's run this and see what happens. Okay, good. So you can see that our Apple variable got created, and the indication for that is this Apple, that's data in the top right corner is variable has been created, and it automatically says that this is an XTS object. XTS is basically extended time series object, basically, and you can say it's a time series because all financial data primarily depends on time as the most important parameter to determine what is going to happen to it, right? So time is the most important parameter to model a financial information. Let's click on this and let's see what happens. So you can see the opening price, the high, Apple low, close volume, traded, adjusted closing prices of the stocks. So if you would know your candlestick chart, right? We will do some of the chartings, and when we will do the charts, we will see. But I hope most of you are familiar with candlestick charts. So this is you can see each line represents one candle for you, right? One candle. So we have the opening, the high price. Um, so this is a day's data, right? We have every day's information being stored all the way down from 2019 1st January. We don't have the 1st January, maybe because 1st January was not a working day. We will have the data only for the days in which the market is open. Uh, for other days, they don't store the data generally, and we don't need also. because we know the price will not move on the days the market is not operating. So this is a most common and a most simple way to get the data from a particular platform. In this case, we are getting the data from Yahoo Finance. There are other data sources like R has its own package called as EdHec. There is the one more. That is another package that also has some data to it. For NSE, we have a data called as NSE2R um, for the getting the NSE stock exchange data. That is a national stock exchange for India. Similarly, we have Indian stocks uh, library where we can get the Indian stocks data and remaining other data sources, right? Now, we will talk about a simple concept called as returns, right? Now, what do you mean by what? How do we basically apply returns? Uh, so returns are basically two forms in nature, right? One is your discrete return, and another is something called as um, a continuous return. We will see the difference between the two and why both of them are important. We will also know in one of the case studies that we will do for BMW. But prior to that, let's get a little bit more familiar with some more libraries in basically in R, right? We want to get more familiarized with. Now, let's say we want to create a variable called as uh, opening prices for the for this stock. So let's create a variable called as opening, and the library that the function that we will use is called as op, and we will just have to give AAPL. Sorry, it's case sensitive, so we will have to maybe use this. So let's run it. Okay, I think we will also have to use a few others. It's not O, it's OP. Okay, it's case sensitive, so it will have to be careful with the cases. Now, you can see this variable contains the opening price of APL. Similarly, you can use what if you want to see the high prices, you can just type in HI and you can run what is the high price of Apple, and now the opening price will have the high prices of Apple. Now, let's say similarly for low prices, we will have something called as LO. For closing prices, we will have something called as CL. Now, the closing prices are something that is the most important thing. Either the closing or the adjusted prices, adjusted closing prices. These are the two most important parameters that we use to determine the returns. Now, let's say open. Now it has the adjusted opening prices, right? So because we are overriding this variable with a different uh, function altogether. So this is how we uh, store the different elements of a stock, uh, uh, or any financial instrument for that matter, because every financial instrument will have an opening value, a closing value, a high value, and a low value, right? And that is how you decide when to buy and when to sell. What is the most important rule in trading? Sorry. Most important rule in trading is your understanding of the trend of the market. Now, a trend is something that it it can be for any period of time, right? So in general, you see a trend. Now, how do you decide when you need to buy and when you need to sell? So your candlestick charts and your various technical indicators come into play then and help you decide whether the market is actually bearish or market is actually bullish, right? Or the behavior of the stock is actually whether it is overbought or whether it is oversold. That is the most important parameter, right? You have to decide whether the particular financial instrument is overbought or oversold, and that is what will help you decide when to enter the market and when to exit the market. Be very clear with this. Anyways, that is more of a financial concept. Let's see some other formulas where we can analyze some of the other data sources. Let's say we want to know what is the weekly volume of the trading of Apple, right? So let's say we want to see week. Anybody wants to say something? Okay. Anyways, let's say week. Um, I want to find out what is the weekly volumes of the trading that has happened for Apple. So we can use this function called as apply dot weekly. This is again a quant mode package. Only when you have a quant mode installed in your environment, you will be able to see this function. There is a function called as VO, which will give you the volume. Now you can use AAPL. This is, and let's say I want to get the sum, right? So you can see the different uh, things that you can do. You can find a summary, you can do, there are like thousands of things that you can find out. I want to just find the weekly volumes of trade that has happened for um, Apple. So I created this volume, and you can see weeks data. What is the weekly summation of volumes of trade that has happened on Apple stock? That is what it will give you. Similarly, you can do apply monthly. Let's say I make it a more volumes trade. I can do it monthly also. So you see, it automatically comes, and this, I want the summation itself. So once I run it, I will be able to see the monthly. You can see it's a monthly. Similarly, I have quarterly, I can see yearly, and so on. So these are some of the things that we can do with this package quant mode. We can see all the financial information and do all the kind of mathematics in and around it in order to understand or do the basic exploratory analysis of any data. Because whenever you want to buy any financial instruments, you want to know what has happened over it, how the various factors have behaved over a period of time in the past, and the only source of information that you have rightly available with you is, let's say, last 1 year's data, last 2 years data, depending upon the time when the company started, right? So that is the only information you have. Then but you also know that there is others factors like the general market situation, let's say the market factor. So the other factors also start coming into picture, but in general, um, you will have to eliminate all the other non-stationary factors from your data in order to analyze what is the stock's pure movement means, right? So market will have a role to play in the stock price getting low or high, definitely. So but that is applicable to every other stock also, but that doesn't mean that your stock is, if it is going down, is a bad stock. So you have to eliminate that and then find a times, then find a trend of which is going to give the real valuation of that particular company, which is again, in this case, it will be a share price or the stock price. Now that is one thing out of it. Let's see some of the charting methodologies that we have in some of the simple charts we will start with. So let's say there is a simple formula which we can use, which is called as chart series. This is there are a lot of charts that we can use, but the most important, most easiest chart that we can use is something called as a chart series. So let's analyze charting data, right? So let's say I want to chart Apple prices using something called as type line. Um, Again, no uppercases. Let's say I will type it as line. Yeah. So type is line. Now I can give a subset. Subset in the sense I can give the year of denomination for which I want to um, um, plot it. And let's say I can give some theme or some decorative item called as chart theme. Let's use something called as chart theme and make it white. Let's say I want to make it white. So let's see what happens when we draw this. Okay, it is not APL. Let's let's create this variable called as AAPL, which will because right now what is happening is like we have all the prices. Instead, let's first see if we what happens with when with just by typing AAPL. Yeah, so let's call it APL. We can use something called as get symbols. What happens here is we don't have that specific period in which we are um, using it, right? So let's use that APL and symbols. Installed it, right? I think I will also have to use something called as library. There are other libraries also we need to use in our um, day-to-day types, right? Which is also called as there are few other libraries which we will need to use. The first library that we have is something called as performance analytics. Performance analytics is another library that we will be having. Then what the other library that we will have is something called as uh, portfolio analytics. We will need all these libraries um, in order to apply our data, right? Now let's see. Let's run them. I will come and discuss this in more detail later on. But in order to install these packages also, you will again have to use something called as install package, and then you will have to give the package name. So let's say portfolio analytics. Okay. Then you have something called as performance analytics. You can see performance analytics. All these you will have to use it as part of your um, uh, right. So let's see. So you get a beautiful graph on the right, and you can see the opening and the closing prices for each days. You can see the volumes that has been traded on each day. It's from, I have given the time period as 2021. So you can, it will give you mostly the information. So you can zoom it. There is an option called a zoom here. Just click on zoom, expand it. So you will have the day's data. And remember that you will not have the data for the days in which it has, which the market is closed. The Saturdays and Sundays and other public holidays in which the market remains closed, you will not get the data for that. But this is how you can use the chart data. So you used the chart series data in order to um, plot the data of 2021. So what does this say? What does this trend tell you? Is it an uptrend or is it a downtrend? So if you had your candlestick charts, what will you tell this series? You have the high, you have the high, then you have the low, you have the high, you have the high low. For a certain extent, you can see that this is an upward trend in the initially, but later on your high lows became your low highs, your it went on decreasing, right? See, your lows are going on increasing. So basically this is a downward trend, or the price of the stock has been at least into 2021 it has been decreasing. In a way it has started looking up, but then again this will go down. If you do your technical analysis properly, then this is basically um, um, a downward trend for Apple. Interesting, right? So Apple prices were very high somewhere in Jan. Suddenly come April, uh, we see a dip. So that is one way to look at it. Let's say I want to use something called as bar. Let's say I can change the type to bar. Now let's say I will run this. Uh, so now you see that it's not exactly a bar, it's lines. Again, a line, but it's a, or is it's a vertical line, and it's kind of a test candlestick. See, you have the highs, the lows, and the and the volumes traded, right? It's kind of a candlestick chart that you can see, uh, and that is how you decide your things. Uh, Actually, let's use specifically instead of bar something called as candlesticks. So candlesticks, we can directly use candlesticks actually. Um, yeah, you see the beautiful graph with the candlestick. We all know what's the green and the red indicate, or the orange in this case indicate. Greens indicate on that day the closing price was higher than the opening price, and a red represents that on that day the closing price was lower than the opening price, basically. And there are other aspects like supports, resistance, and all of that. I'm not getting into all of the details of a candlestick charting technical analysis. We should be familiar with only some basic parameters, right? You can see that the candlesticks, the the orange ones are pretty low, is pretty low, right? What does it tell you? That means that there is a downward trend in this information. Now, let us see something more. Um, let's do a different, um, in subset, let me try using particular month. So let's say 2021, 03. I will use that. Now let's see what happens. So if I zoom it, so this is only for March. So if you see, I gave only March's data and how that behaved in March. In March, it is not really a downward trend. You can see there is a high, there is a low, there is again a high, and there is a support and there is a resistance. So we can say that yes, it was still in March. You could say that it was reasonably uh, um, reasonably good stock to buy. Yeah, right. So you can use play with these parameters like subset, type, in order to see the different types of financial parameters, right? And this is helps you in analyzing your data or doing the exploratory analysis on your data a lot better. Uh, let's now that is one part of it. Now let's move on to something called as indicators. Now, let me ask you this question actually. In technical analysis, what are the important technical and indicators that we use? Can anyone tell me? What are the important technical indicators in identifying price movement, or let's say in identifying um, overbought condition, oversold condition, or let's say bearish market or bullish market. What are the what technical indicators we use? Can somebody has an idea? Remember from your finance classes?
Sir, um, are we talking about candlestick charts and all, like historical data or historical trend
Candlestick
analysis?
chart is what we draw, right?
Right, right.
So candlestick charts, yes, that is the basis of everything.
Right.
Um, but yeah, so Kumar sir said RSI, very, very good. RSI is one of the prominent indicators that we use in analyzing price movements. Um, anyone else? Any others? What is the full form of RSI? Okay, let me give you a brief about the technical indicators that we use. RSI comes a little later. It's one of the uh, last resort type of indicator, relative strength indicator. Very good, Saurabh. Yes, it is called as relative strength indicator. Even before using, so when you are actually in a trading situation, even before using RSI, there are other technical indicators that you primarily depend on in order to understand whether the market is overbought or oversold, or particular stock is overbought or oversold. That is what will help you to decide when to enter, when to buy, when to exit. That is what will help you to determine your returns. The first important technical indicator that we use is the most simple uh, indicator, which is called as the simple moving average. We all know about the simple moving average. What is the simple moving average? Uh, in simple moving average, in order to predict let's say I have to predict tomorrow's price. Tomorrow's price of something. What I will do is I will take last 15 days, 20 days, or 25 days, depending upon my choice. Let's say I take last 20 days data, I sum it up and divide it, get an average of that value, last 20 days data. So that becomes my 21st day data. In my 22nd day, let's say I am on the 21st, I am on the 20th day, and I have to predict 21st days. So I will use the last 20 days. Similarly, for 22nd day, I will not use the first day. I will use from 2nd to 21st in order to predict predict the next day's price. It's the most simple parameter that we can think of. We all mostly know simple moving average. In case like I was just refreshing the concepts, I understand most of you know it. The next important technical indicator is called as the exponential moving average. Exponential moving average is a variation of your simple moving average, where we add a parameter called as alpha, which is called as a smoothing parameter. In a sense, we want to give more weight to the recent events. Means list, if I have to plot for the last, if I last 20 days, for the initial period I will give more weight, and as for the as we go back in the past days, the weight will gradually decrease. So why do we give more weight to the most recent phenomena? Because we expect that what has happened yesterday will have more impact on me today than what happened to me 1 year before is going to have impact me today, right? Something which happened 1 year back may not be that significant what has happened one day before, right? For a stock, specifically in terms of price. So these are the some simple indicators. Now, the most important trading indicator that is being used is something called as Bollinger Bands, right? There is a variation of Bollinger Bands, which is even more um, used. But Bollinger Band was the original concept that was being um, coined. Now let's talk about a little bit about a Bollinger Band. Does anyone recall what is the Bollinger Band? Okay, let's. So Bollinger Band in a technical analysis tool is one of the most key components. So uh, let's see um, some of these technical parameters in our charts that will help us understand a little bit more in depth about some of these parameters. So Bollinger Bands is there. Then there is another very important parameter which we call as MACD. That is called as moving average convergence divergence method. That is another very important parameter that is being used in trading day to day. I'm giving these terms. You can understand. So these are what general day uh, people who manage portfolios, people who manage your financial analysts, they use these indicators day in and day out. What is most important is when to use. See, all these indicators are there, and they will give you some story, but none of these stories is actually the complete story, because none of these indicators can tell you what the future is going to be. Nobody has predicted future, right? And I don't think, unless and until you have a machine which can see the future, that will be like what will be the. But since so that will be something like what we have in Krish, right? We used to see the future exactly how it happened, but you cannot see the future exactly the way it happens. So what you do is basically you have these tools in order to give you a simulation of what the future is going to be. What is more important is to know in which situation use which one of these indicators, and that will come with experience. Once you know all these indicators, then you have to know in which situation what to apply. So unless and until you are very experienced, you won't be able to immediately say that, but it's for your knowledge. So MACD is basically what? MACD is basically nothing but the difference of a simple moving average of a 12-week period with a simple moving average of a 26 weeks period. So SMA 12 minus SMA 26. Why do we, let's say, a shorter distance, a shorter simple moving average, when we take a smaller simple moving average time frame, we are using more of the recent data. So when you talk about SMA 26, it takes last 26 data. When you talk about SMA 12, it takes last 12 days data. And so you have to devise. So the more important rule is you have to know your more recent activities have been more prominent over your past activities. So MACD gives you that indicator. Bollinger Bands gives you the indicator of the market's volatility. So it is plus minus a few standard deviations from your simple moving average. Everything, all of your indicators moves in and around your moving average, most of it. There is another indicator called as momentum. Momentum and RSI, as Saurav said. RSI, relative strength index, and RSI and momentum are pretty close to each other. They say how well your stock is being bought. Yeah. So that is a relative strength index. Good. Now let's see how we can plot some of these and how we can use some of these indicators in our analysis, right? So let's the most important, most simple um, average is something called as simple moving average. Um, so let's say I will use another. The libraries we always have to use in every R session that we initialize. Here I will also use a library called as TTR. TTR is another time series so object. Um, so basically it is used along with quant mode in order to analyze and it has some of these uh, technical indicators which we will see how we use them. So let's create a technical indicator called as SMA and okay we have to use something called as our Apple. In this also, let me please clean this up. Let me clean this up. Let me clean this up. Let's call it um so your APL data is there. Now let's use a simple moving average. How we can calculate the function that we use is called as SMA. SMA, okay. And I want to use the closing price for getting the simple moving average. And so we know that the function that we use for closing price of particular stock is called as CL. And CL in the bracket, I will type in the stock name, Apple. Now let's say I want 20 to estimate 20 means 20 days simple moving average concept, right? Um, so when I just have to do and run it. So you can see SMA has got created. So there are a lot of NAs here. Why do we have so many NAs? So for the first 19, for the first 20 days, you won't have any data because there is no simple moving average for the first 20 days. Your first moving average comes on the 21st day, which is the average of your past all these days, right? How does a simple moving average work? It generally takes the average of all these actual prices uh, along with this value. So your simple moving average works like this. Similarly, for this, what it will use, it will eliminate the first day and it will start using from the second day all the way down to the predicted day also. It will include the predicted day. So this is a predicted day, which is, let's say, tomorrow. This is day after tomorrow. And we have the last 20 days data. And it is subsequently using the simple calculating the simple moving average for the corresponding period that it wants to. Right? Clear, all of you? In order to, there are some simple functions, like we can use a function called as tail. Tail is used to get, let's say, the latest, let's say 5 days data, simple moving average. So I can use this function called as tail, and you can see what is a simple moving average for the last 5 days. And you can see 2000. So today is 7th of April. So from 6th April, 5th April, last 5 days data, this function is going to give me. So I know what is a simple moving average for a particular stock. In this case, I'm using Apple, so that is how it is. If you had to do the same thing in Excel, you imagine, you know how difficult, means it's a little tedious process in Excel. So you need to use all those column formulas and row formulas, array formulas in order to apply all those things, right? And in R, you see how easy it is. Just a simple SMA program is just giving you the simple moving average for a number of period, and I just need to call a tail or a head command in order to say what is the duration of the period in which I want to see. Now let's now let's uh, sorry. Now let's say we have to calculate the exponential moving average of Apple. Now, what is the command that we will use for exponential? So we will use something called as EMA. So the formula that we will be using is called as EMA, and the rest of the things remain the same. Let's run it. Okay, I think the result n equals to EMA. I think there is one more comma here. Okay. So you can see our exponential moving averages here also. So it automatically takes into account the exponential moving average for the given period. Now you can use the same function here also, which is called as tail. Now here I will just use EMA, and as soon as I run this command, I can see the last 5 days exponential moving average data for my given stock. So that is exponential moving average. And now let's say, now the next important technical indicator that we had was Bollinger Bands, right? Now Bollinger Bands are, how we can create it is something like this. The function that we use is something called as BBM NDS. And if you saw this, when we were writing this function, it gave the library from where it is derived. This is TTR. So you see, this is the library which gives us this BBA Bollinger Bands function, right? So you can create your Bollinger Bands. I can use this same thing. Yeah, closing prices. Now there is an important difference. I cannot give the period which I gave here 20, right? In Bollinger Bands, what we give is basically something called as standard deviation. And in general, we give a standard deviation of 2. So let's run it. So you have your Bollinger Bands. So you see your Bollinger Bands. What it has given you? Down, moving average, up, and percentage. So this is your moving average, the middle column, and you have your upper band and lower band. So this is how you calculate your Bollinger Bands. We will also see how we chart it out in one of our lessons, but this is a very important parameter to use. Now, there is another very important parameter which is called as ROC, which we will be using in our portfolio methodology creation, a case study that we will be using. We will use this concept called as ROC. ROC is basically when we were talking about the cumulative continuous returns, that indicator is very important indicator. It is a price rate of change. It is a technical indicator which measures the percentage change between the most recent price and a price in the past, right? It's very simple. Price, most recent price with a price in the past. That can be any time period prior to this price. Now, what happens generally is when the price moves, you have to calculate the ROC based on a particular period. I introduced the concept that is something called as the discrete return of price as well as continuous return of price. In portfolio returns, we always use something called as continuous returns. Continuous returns are nothing but your logarithmic returns of your price index. Logarithmic returns are very important indicators for your price change movement. Now let's go ahead and see some of these in the technical analysis. So the okay, the function that we use is something called as, we saw the Bollinger Bands. Now let's say ROC. So for ROC, the function that we will be using is again called as CL ROC. And here there is one important thing that we have to give is let's say I want n equals to 2, means 2 time periods prior with the information. So you get the ROC, you can see the ROC 2 time periods prior. So we have the returns for each time period correspondingly, right? Now MACD. I introduced this concept called as MACD. MACD is another very important concept. MACD is tells you the moving average of, let's say, of 12 and 26 is the general that what we use most of the time. A simple moving average of 12 minus a simple moving average of 26. Okay, so let's close this. Let's use this. Now let's important see what are the important things. There's a concept called as N fast. This is what will give you the upper MACD. Means the lower value of your simple moving average value. This is the longer duration. And slow it gives you upper. You can change these parameters, but this is the most important parameter that we use. Then there is another thing called as N signature, N sign. So which is 9 by default. Let's uh, keep it as 9. Another important, the moving average type that we want, we can change the moving average type uh, based on, in this case, we will use SMA. We can also use exponential moving average because basically when you're talking about MACD, you're um, seeing what is the, so let's conceptualize what MACD is. MACD basically says what is the more recent period, average of your more recent period price minus the average of a longer duration of price. What it means is if your MACD is higher, your means is your there is an upward trend in the market. So your market is growing, means the price will be increasing. You're expected to the price will increase. Means your if your 12-week or a 12-day moving average is more than a 26-day moving average, that means that your price is going to move up. So let's create this and see. So we have created our MACD and let's, so signals, so you can see the signal is what you get whenever the MACD is higher. So that is what is one of the indicators that we will use in our calculations. So that is MACD. Similarly, we also have RSI. RSI generally we don't use a lot in the sense in general because it is more becomes like a momentum which we by analyzing the MACD and the Bollinger Bands we can tell what is going to be the RSI similar. So these are some of the technical indicators that we use. Um, Now, we were using some of our charts, right, from our last class, from our last section. Now let's plot some of that. So let's use this chart. 2021. I don't want to subset it. So charting we will use. Let's say I don't want to give any type here. Will not give any type candlesticks or anything. I can use the type, definitely not a problem. Let's see what happens when I don't want to give a type. Let's say I don't want to give a month. Let me keep it a month. That's not a problem. So let me use closing price of Apple here. Let me see what it is. Okay, good. So I have a closing price of Apple for 2021 mm, for the month of March. Let me not keep it for March, keep it for a bigger period of time for the entire 2021. Uh, so zoom it, you can see the price movement, right? You saw it. By default, it takes the line is the default, so it will by default it will take the line. If you want to change it, you can give the type. But our idea is not to change this. Uh, but let's say if I don't use the CL, I use just AAPL, then what happens, right? Now you see the candlestick charts automatically coming. The reason is you are having all the elements here, right? You have the volumes, you have, so you can see the volumes, you have the opening price, the closing price, and everything. So by default, the chart that takes into account becomes your candlestick chart. Why does it become from a line chart to a candlestick chart? Because now, if you would very carefully see, APL has all the data: your opening price, your high price, your low price, your closing price, your volumes, your adjusted price. But when you just call your closing price, what happens is it takes only the closing price, and returns are generally calculated based on your closing price. It can be a logarithmic return or it can be your discrete return. Either ways, uh, both are used depending upon situation. So what happens in this case is basically this is what the general trend looks like. Now what I want to do is I want to add a simple moving average line on this graph. Okay, I want to add a simple moving average line on this graph. Let's see how we can go ahead and do that. Right. So the function that we use is called as add SMA. Right. So let's say add SMA. You can see get automatically this function called as add SMA. And add SMA, let's give the period number of days. Let's say I will give 30. Okay, it didn't take. N equals to 30, number of days 30. And let's say this is the size I want to define, and the color I want to define. Let's say it will be blue is better. Let's add this, run this. You see, now let's zoom it. So you see this simple moving average line is automatically drawn on this graph, and you will now be able to analyze your high, your high low in a much better way, right? So you see that you started with somewhere around in Jan 4 2021. The first day it didn't perform well, but it started on a pretty high price but closed on little lower. The next day it did better. The next day again it went down. Next day again. So all these are values are close to your average moving average lines. But if you see there is a spike here where there is a slight increase, but then your moving average is going down and down. Now this gives you a very important trend. In the end, you see that it is your moving average is almost flattening out in spite of your candlestick charts showing an upward trend here towards April 6. If you see in April 6, the prices increased, but your moving average will not change because it is taking into effect last 30 days values and taking an average. So it is easing out your overall valuation. So that is how we add our uh, moving average, simple moving average. Similarly, let's add, let's clear this out. Let's add another chart. I can just change it to add exponential, which is add EMA. And I can first let's draw the chart, the upper chart again, which is our chart, and then draw our exponential moving average. So this is just I changed the simple moving average to exponential moving average. Now you can see the exponential moving average price formulations. That is the next part of it. Now let's draw the other very important chart, which is called as the Bollinger Bands, and there I will show you how to interpret. So let's draw our initial chart, and I want to use this. On top of this, I will use something called as add bands. Now, Bollinger Bands. The first parameter that I want to pass is that number of days. And the second parameter, the ST, standard deviation. Generally, we use a 2 standard deviation in Bollinger Bands. Now, you see. So, what does your Bollinger Band actually telling you here? What does your Bollinger Band is actually telling you here? Remember, Bollinger Band is always takes into account the market volatility. So the market volatility, whenever the difference between your upper band, so if you see there is an upper line, there is the moving average, simple moving average, which is your middle line, and there is a lower red line, which is your lower band for your Bollinger Band. Whenever the market is more volatile, the difference between your upper band and lower band is very high. Basically, standard deviation is an indication of what? Is an indication of market volatility. So the difference between your upper band and your lower band, what it gives you is basically gives you your market volatility. Can you find out an important trend in this chart? So I'll tell you, there is one very important trend. Whenever the Bollinger Band is very high, let's say Feb 01 2021, you can see the difference between your upper Bollinger Band and your lower Bollinger Band is pretty large. That is an indication that the market is more volatile, and it is likely that the price will fall. And you can see the price falling as predicted by the Bollinger Band. Another important factor is whenever the difference between the upper Bollinger Band and the lower Bollinger Band is less, that means that the market is less volatile. And that means that you can expect a price increase. As you can see, Jan 19. See Jan 19, the difference between your upper Bollinger Band and your lower Bollinger Band is lesser. And hence you're seeing that there is a spike in the price. For how much period it will continue, that you will not be there. But you can say that in the near term, you are expecting an improvement in the price or the stock price of your portfolio or your price. That is a very important concept. So April 6 also we have a very less Bollinger Band. The difference between upper Bollinger and lower Bollinger is very less. So we expect uh, an increase in the price, let's say over the next 5 days. Uh, if you want, you can try your luck, try investing maybe a small amount of money, and let's see how much you can make in 5 days. Because this says that you might see an increase in the value of the Apple price over the next few days. Because you can see the difference between your Bollinger Bands. One very important concept. So that is your how you visualize your Bollinger Bands in quantitative finance. There are other indicators also, um, like the ROC is another very important indicator, which is gives you basically, it's a very simple indicator, right? ROC just gives you what is the difference between a return of the most recent period, um, along with but that really doesn't tell much on the um, what do you say as your prices. Um, so let's actually give it. So the function that we use is called as add ROC, and we have to give a time period. Let's say from the most recent period to 7 days back. That is what I am trying to draw. So you can see the ROC curve here. Sorry. So you can see that there has been ROC is also indicating that there is in the immediate future there is it's an upward trend. But in general, over a period of month, if you will see, it has been generally it has been a downward trend as far as the candlestick charts go, right? So that is about some of the important technical indicators that we use. Now, let's get into actual trading. How do we means like actually create a trading strategy? Now we know how to get the data. Let's say how to know how to create our charts, how to create what are the different type of charts in order to analyze our data. We also know how we can add the different technique, what are the different technical indicators that are used in simple moving in technical analysis, how we can plot them, and how we can use it along with a candlestick chart in order to define a particular trend, in order to understand, right? So those are the few things we have learned so far. The next thing we want to do is we want to take a case study, let's say a simple case study, and use it to our knowledge. So let's say at the end of this exercise, I will ask you what is the concept that I have used, or which trading indicator I used in order to create this trading strategy. I can use any one of the trade indicators in order to create a trading strategy. Means. So let's import our libraries. That's the first important thing that we have to do. Is the first important library is called the quant mode. Quant mode is the first important library that we use. The next library that we will be using in this case is something called as tidyverse. Now this is again, these libraries, they are used for specific purposes. Again, tidyverse is one of the plotting libraries, or it helps you to analyze time series data better. So that's, and our other library which we have seen is TTR, which we know all of the technical indicators are present in the TTR library, but that is used along with quant mode. You have to use both quant mode and TTR in order to use both the technical analysis aspects. Right? Now, let me clear out all these actually. Clean the environment. And, let's create our library called as not. Let's create a variable and get symbols. We will use a company called as automatic auto parts, which is um, has a ticker name of AAP in get symbols Yahoo. In this case, I can also use this function called as source equals to Yahoo. Anybody was saying anything? No problem. We have to use auto data sign. Why do we use this specific function called as auto data sign equals to F? Is because we want to get the data from Yahoo for AAP stock and store it local in the local environment. This is what this function does, right? The next thing that I want to use, I want to use I want to make sure that the return data that I get is a time series object. How we can make sure of that is by using a formula called as return.class equals to XTS, extended time series. Not necessary that every data that you will get will be in the time series format, maybe. So once I give this extended time series return.class, it automatically makes my all the data that is available in the form of time series. Now, if you would have seen every financial instrument had a opening, closing, open, low, high, close, volumes traded, and adjusted closing price. Adjusted closing price was the last column of your data. I erased everything, so you would have seen the last column. Let's actually see it. That will be better. Let's run it. First, I have to run all these libraries. Always remember. Always remember, before running your program, you have to load the libraries in your environment. So AAP, if you will see, you have all these open, high, low, close, volume. So you have 6 columns by default. If you have to refer, I want to use the adjusted closing. We can either use the closing price or we can use the adjusted closing price to calculate the returns. In this case, I want to use something called as the adjusted closing price instead of the actual closing prices. Adjusted closing prices are a more prominent, better way, which a better indicator for the price of that particular day. So what I want to use, I want to refer the last column. So I can just within square brackets, I can just give comma 6. Comma 6 means before comma, I have nothing here. I have, that means select all rows of column 6. This particular sentence tells me select all rows of column 6. Now, if I run this, my AAP will get automatically adjusted. So that is our just a second, yes. So if you see, you get only the 6th column of your data in your environment. Now we have what we need. The next thing that we want to do is the next thing that we want to use is something called as we have to calculate the returns. Now we will get the differential returns, right? I will come to a why we needed a differential return sometimes, but right now let's say I want to see a continuous logarithmic returns. So let's calculate returns, right? So the variable that I want to use is something called as REAP return. And don't worry, I will send you all these codes to you after the end of the class, and you can practice them on your own. Let me know if you have any questions. But yeah, what we are using right now is basically calculating the returns. So let's calculate our returns, which we use called as diff is a function that we will be using. And what I want to calculate is logarithmic of return. What is basically what this basically does is, let's say I have 1 day's data, next day data, third day data, three. Let's say I have 3 days data. It will take the logarithm of the third day, logarithm of the second day, logarithm of the first day, and it will subtract the logarithm of the third day's closing price with the logarithm of the second day closing price, and this is what it is going to give you the return. The return is nothing but the closing price of 1 day with the opening price. That is what. Now let's give it a column name to AAP returns. So the column names to AAP return, we can give it as AAP. So let's run this. So now you have AAP and AAP returns. If you can click on AAP, so you have the AAP returns, and AAP return, you have the for each day you have the returns, the logarithmic returns, basically, right? So you created your returns. Another thing that we want to do, if you remember, I didn't give any from statement here. So let's say I want to use 2020 data, right? Let's say, so I want to trim our data return. So AAP return, I can trim it after getting the data also. That is what I wanted to show you. AAP return, and in bracket, if I, let's say I want 2010 data, that's so I can just give this function 2010 /. And similarly, I want AAP data also to be for 2010. So I just give 2010, right? So let's run this. So now if you see your AAP return, it's only for 2010. Let's say I want, let's see if it has 2020's data also. If it is for 2020, we can use 2020. Let's run it. So it will have 2020's data all the way from January all the way till, if you go down, it will be December. So I want to use a more let's say we use the 2020 returns. The next thing that I want to use our trading indicators. Now, so basis of most of our indicators before is technical indicators move in and around one of the moving averages. It can be an exponential moving average, it can be a simple moving average. Now, simple moving, now there are variations, right? You have your additive, multiplicative. We will also discuss the concepts on ARIMA, autoregressive moving average models also, and why do we need, actually, when do we need autoregressive moving average models also. But for the time being, like, let us focus on the most important, most simplest moving average that we know of, which is the simple moving average calculation. Now, the simple moving average calculation, we have seen how do we calculate it, right? I want to calculate a 26-day moving average, which is again 26, right? And I want to calculate a 12-day moving average, which is called as SMA. Remember, guys, at the end of the session, I will ask you what is the actual technical indicator I've used to create our trading strategy. So keep that in mind. Data. Now, what is our actual data for the averages, right? Basically. I'm sorry. I want to bind all the data together, like my price, my returns, my 12-day simple moving average, and my 26-day simple moving average, like in Excel, right? We have one column next to each other. And I want to do one more thing. I want to omit all different types of any zero value error. So I can use something called as data dot frame, and in the bracket I use something called as the function called as column binding. In column bind, I will give the different column names I have specified, right? We have AAP for AAP prices. For returns, what is the column name we have? AAP return. For a simple moving average 12 days, what I have, SMA 12. And for simple moving average 26, what I have, SMA 26. We have already this. I think I didn't run this. Now let's run this data. Okay, guys, one thing more. If you would see, I have used a command called as data.frame. Uh, you might have studied, I'm pretty sure that data frames would have been introduced to your introductory R classes. Just to refresh your memories, data frame is a type of variable that we use in R that is used to store any kind of data, whether it is string, character, or numerical data in column and row format. It is just, you can say that it is like an Excel sheet. In Excel sheet, you have rows and you have columns, and each row can have both numerical as well as string data, character data. It is able to possess. Similarly, R gives you data, R data frame gives you all those capabilities to store your data in a sheet like Excel, but it is, now you can just imagine that it is R is your Excel platform. So now this data becomes your Excel data tab. You have Excel tab, which has a tab, Excel sheet, which has a tab called sheet name called as data, and it has this all these columns. Now, so if you click on this data, you can see all this based on date. You have all these SMA 12, SMA 26 increases. So different as different these all these columns that um, you have, right? Um, it took automatically the column names, so that is not a problem. But this has your basically the adjusted closing prices. This had your differential logarithmic returns. This had your simple 12-day simple moving average, and this has your 26-day moving average, which is now I have them in Excel columns, or you can say as a data or data frame columns. Now, the way we can call one column name, um, or rather, let's create the way we can create another column in a data frame. Like in Excel, you can create another column. How we can create another column in an Excel is how we will see next. That will be our trend following strategy. That will be our strategy of trading, right? We definitely use a trading strategy, as we have already seen, and we will be using the same trading strategy here also. So let's create our trend following. So let's create a column in our data. I will call it an Excel sheet, data sheet called as UD. Okay, data dollar UD will be a new column that we will be creating. And what this column will contain is, I'm using, we use a if else formula in Excel. I will use a similar formula like if else. What is if else? If my data dollar SMA, somehow it, this SMA didn't create it. SMA 12, column 9, SMA 12, SMA 26. Let me run it once more. Taking some different names, not a problem. So Basically, what it saying is SMA is your SMA 12 day, SMA 26 your SMA dot one. So that is what the names are taking. So let's data dot dollar SMA data dot. If my 12-day moving average, the trading rule that I want to create is if my 12-day moving average is greater than my 26-day moving average, which is denoted by my SMA 1, code it as 1, else 0. Right? Now let's run this. Okay. Now if you see, you will have another column called as UD. If your 12-day moving average is more than your 26-day moving average, then it is coding it as 1, else it is coding it as 0. We will know why. Uh, I will ask you this question, why I have done this. It is from our technical indicator lesson that we had discussed in the past. In our technical indicator section, it is from there. So let's devise a trading strategy and back test. Right? Let's devise a trading strategy and back test. Right? So spelling is wrong. Strategy. So let's so so let's devise a the trading strategy that we want to see is if my this column is equal to 1, then I want to buy, else I want to sell. So let's create another column called as trade, data data trade. And what I want to store here is called as if else. Uh, okay. If else, what I want to call it? If else my data dollar UD is equals to 1, data dollar UD is, so for equality we use something called as two equal signs in R. That is the sign that one variable is equal to another. So if you give only one equal sign, that will become an assignment operator, which is not their case right now, right? We want to compare the values, not assign a value. So buy and sell. So that is the, so if my, what it has essentially means, if my 12-day week moving average is more than my 26-day moving average, then I want to code it as buy, else I want to code it as sell. Right? Now, if it is a buy, let's give a number 1 to it. And if it is a selling position, let's give a number -1 to it. So that will create our position. So something called as, we will use something called as data dollar position. Let's say we want to create another column called as position. Data dollar position. And what is will be our position? Let's call it if else. I want to say a data dollars trade um, is equals to buy, right? That is what we have. Buy here. Data dollar trade, it has either buy or sell. Then if it is, then I want to code it as 1, else I want to code it as -1. We will see why we are doing this. So let me run this first. So data, and let me run this also. Cover position. So we are only adding columns after columns with uh, in our data sheet. Now we added this column UD, we added another column called as trade, which is called as sell. And now we have the positions defined. If it is a buy, we want to code it as 1. If it is sell, we want to code it as -1, right? So that is our trading strategy. Now, the next thing that I want to create is the returns. What is the returns, right? Um, Data dollar, let's say algo return, algorithmic returns from the algorithm that we have created, which is our creation. Um, Data dollar AP return, APRET. Um, I think we have, it's only AP. AP is basically represented by AP in our uh, data set. Star data dollars position. Yep. So I want to multiply the returns. Let me show you. I want to multiply these returns. This is my logarithmic returns AAP column with my position. What will happen if it is a negative -1? It will sub create a. It will just multiply this number with this number, right? So that is how we have created our algorithmic returns. And let's now create our, let's create our algorithmic returns. Now if you see, so you have your algorithmic returns of your strategy, right? So you have the returns, algorithmic returns for your different strategy. Now you have to find out your cumulative return. So what is going to be the cumulative returns for you for your trading strategy that you have created? We will call it annualized return. And in this, what I want to store is something called as mean data dollar algo return +1 mean data algo return +1 what to the power of 252, right? -1. I hope this makes sense. This is my daily returns. I want to create my annualized return or cumulative return. So this is the cumulative return formula that we have. We have 252 days, trading days in a year. Rest of the days are non-trading days. For 2020, I will say that this was our number of trading days. This is our annualized return. So let's calculate what is our annualized return. So you see our annualized return is coming a little negative, negative 13%. So maybe we should use a different stock altogether. But that is what is our annualized returns are coming to. Let's plot our returns. If it is the plot AB returns, Let's plot it. So you see there is a certain spike around in this. There is a large standard deviation in April. We're expecting a downtrend in AAP prices. Not a right time to um, buy. In 2020, there was a huge April. We know because of that. In April 2021, actually, it has stabilized a lot the price, which we expected anyways. Now, standard deviation. How we can calculate is using the formula called as SD data dollar algorithm. So this is going to give me my standard deviation. So standard deviation is 2.0.0288. Standard deviation, we were expecting it to be a little lesser here at this point of time, which is also there. Means it is not that risky an asset. However, your returns are not great. So it's not risky, but you don't have a good return. Now, let's say we have calculate our Sharpe ratio. Now, what is a Sharpe ratio? Mm, so let's tell me a Sharpe ratio is basically for a given expected risk that a person takes. What is the expected returns that he needs to get in order to compensate for the risk that he is taking? So there is a market risk-free rate in the market. So if a portfolio doesn't have any risk at all, means however the market will behave, means it will be the risk-free. There is no risk at all on the portfolio. Then what is the return? And so if you're investing in a particular stock, there is an element of risk involved for it, the price to go down and up. If that price is so you expect a return which is higher than what the market is giving you. Otherwise, you will invest in better to invest in a risk-free instrument, right? Why do you invest in a risky instrument? So that you get a return which is higher than the risk-free return, something that you know of. There is something called as a risk-free return. So your Sharpe ratio is basically nothing but um, your um, your annualized return, minus your risk-free return, which is RF, divided by your standard deviation, STAD, your standard deviation. So I think we have to run on this. So your Sharpe ratio is negative 5.3 to 9. And you can see your um, other parameters also along with the your what does a negative Sharpe ratio indicate? So negative Sharpe ratio, it either means that the risk-free rate is greater than the portfolio's return, or the portfolio's return is expected to be negative, which we have seen. This portfolio's return is negative. So our Sharpe ratio is also coming as negative. If you see this annualized return is negative, so our Sharpe ratio is also coming as negative by default. So we don't expect any positive returns from our stock. This is how we create our trading strategy. So we will create our trading strategy only when we can maximize our annualized return. So for that, we need to use combination of assets, different types of stocks, and use different types of. So instead of AP, I can use another different stock. Um, let's use Facebook. So I just need to change this to Facebook, and let's clear everything and let's see what it is. Uh, let's say I'll keep everything the same. Just what I have done is I have created and changed the stock's name. So I created my this also, and I created my algorithmic positions also. So I have my positions defined. Now let's, what is the annualized return for my Facebook stock is giving me? For stake book, I'm getting a annualized return, you see, in 0.446, which is pretty high. Now let's calculate our standard deviation. So your sharp ratio 15. So it's much better to invest in Facebook than to invest in AAP stock at this point of time. And if you plot it, you can see the results. Your you have a higher standard deviation, by the way. So it's a risk, not much risky. 0.028 is still okay, I will say, not more than 5%. SARP ratio is pretty high, which is a good indication that it is doing pretty well. So you just by the only thing in this code that you need to change is the price of your stock, or you can use a combination of price of your stocks. More or less, in order to determine the risk-free rate, you can use something called as, we will see in the next class. So for this class, we have covered a lot, and I hope you have uh, learned some new concepts which you may try using it. So with that thought, we will continue our session tomorrow.
Fine, sir. Till now, participants, do you have any kind of query regarding the things which sir has shared?
I'll share the code and other related at the end of the session.
Fine, sir. So we'll be sharing the file with the participants.
Yes, I will share with them.
That whatever the course we have used today, we'll be sharing, we'll be mailing you the content provided by sir by today evening or by tomorrow morning, so that you can have, before coming for the second session, which will be continued by sir, you can have a hands-on practice on that given database. Right, sir?
Yeah, that will be better.
Right. So again, sir, thank you for being here today as our one of the resource person. So tomorrow we'll be covering the topics related to portfolio.
Yes, we
and
will.
the frontier part.
The efficient frontier we will cover. And no, the first thing that we will start with is the next phase of time series modeling for a financial market, which is ARIMA and forecasting methods. Then moving on, we will move on to portfolio analytics or efficient frontier and other things.
Great, sir. So thank you, sir. Thank you, participants. Tomorrow, the first session will be taken by Shripad Kulkarni, sir, Dr. Shripad Kulkarni, sir. He will be going to take content on quantitative finance, right? And the second half, post-lunch session will be taken by Pranvesh, sir, wherein we'll be continuing with the analytical part using R. The topic the sir had already discussed, that we are covering to going to cover portfolio, efficient frontier, and ARIMA model, time series model. So again, a good base, a good learning process will be continuing. So that's all from for today. We'll be sharing the your feedback link in a minute on WhatsApp group. So make sure to fill that link. Again, requesting you participants to fill the link on time, as we'll be closing the link after an hour, right? So please take care of that. So that's all from our side. Thank you, sir. Thank you, Pranveer, sir. See you tomorrow at 2:30 p.m. sharp. Right, sir? Yes.
Yep.
Thank you. Thank you all participants. Any query? Fine. So I'll be ending up with the meeting. See you all tomorrow, 10 a.m. sharp, for the 4th day of our STTP. Thank you all. Savita ma'am, want to ask something? Fine. Okay. Thank you.